This is not a recession. This is a depression. And this will not be over quickly in 6 months or 18 months. This will have intergenerational effects.
Welcome to the very first TCN TV Legends interview with none other than James Rickards. Jim is an economist, lawyer, currency expert, and investment banker. He's also the author of best-selling books and has another in the works. I've interviewed Jim around the world and he's never shied away from a bold prediction. 3 years ago, predicting gold would soar through $2,000 per ounce and Trump would win. And yes, that's back when no one thought it would be possible in October 2016. The world has certainly changed since then. And well, Jim, welcome to TCN TV.
Thanks, Lala.
Now, Jim, you've always been bullish on gold, and you've recently made a very bullish call saying that by 2025, the precious metal will trade at 15,000 US dollars an ounce. On what fundamentals do you base this prediction on? Those numbers are pretty big.
The first one, this is the third great bull market in history. Prior to 1971, you didn't really have bull markets because we were on a gold standard. So it didn't go up or down. It was just fixed at a dollar price. After 1971, that was no longer true. Gold went wherever it was going to go. The first bull market, 1971 to 1980, gold went up over 2,000%. The second bull market, 1999 to 2011, gold went up almost 700%. So if you just took and then of course we had a bear market from 2011 to 2015. The bottom was December 16, 2015 at $1,050 an ounce. It was pretty easy to call because that was a 50% retracement from the high using 1999 as a base. So had a conversation with our mutual friend Jim Rogers, and in the middle of the bear market, he said, Jim, gold will go to the moon, but nothing goes to the moon without a 50% retracement along the way. And I could see that in December we had finished the 50% retracement, and gold was poised to go a lot higher. But if you just took a simple average, take those two bull markets, one was 9 years long, one was 12 years long, so average about 10 and a half years, and take the percentage gains over 2,000% and about 700%. They kind of average around 1,400%. So if you just said a 10-year market with 1,400% gains starting in December 16, 2015, that gets you to $15,000 by 2025. Now, it could well be sooner than that. That's not an iron law, but that's just a good way to frame it. It's just not that much of a stretch.
Not that much of a stretch for some, but for others, gold at $15,000 is huge. Now, another bold prediction that you've made, Jim, was back in 2016, telling me that Donald Trump would win the US presidential election. This was at a time when other pundits were dismissing his chances. Now, as we speak today, the polls are looking pretty grim for the Donald, but you've suggested that it's Joe Biden who might be pushed out of the race in favor of a handpicked nominee supported by superdelegates. Now, why would this happen? And what do you really think are Trump's chances now of retaining the presidency?
Right. Let's separate. I have said both those things. Let's separate them. Talk about Trump's chances a little bit, and I'll briefly go through the Biden scenario. Right now, look, it's going to be a close election. There's no question about that. I would make Trump a slight favorite. He has the potential to be a little more solid ground by election day. But the reason for that, well, there are a number of reasons for it, but one in particular, again, I like to base this on good science and good statistics, but the polls you referred to, first of all, most of them are highly flawed. They're flawed because, first of all, the people they ask the question, they're not all likely voters. You can ask all adults, you can ask all registered voters, you can ask likely voters. Well, those are three different groups. Not every adult is a registered voter. Not every registered voter is a likely voter. It's really only the likely voters that count because they actually vote. And many polls gloss over that, and they talk to a wider audience. And that's not a good reflection of the electorate, number one. Number two, you have to decide on your sample size how many Republicans and how many Democrats. Now, in fact, there are more Democrats registered in the United States, but not that many more. And a lot of these polls, they'll do, for example, 58% Democrats and 42% Republicans. That's wildly skewed in favor of Democratic voters. Something like 54-46 would be a better reflection of the electorate. So the polls are skewed both in terms of whom they ask and the balance of Democrats and Republicans. So a lot of them can be either disregarded or You can adjust them. If you understand what I just said, you can reverse engineer them to get better results. The third thing I would say, many of these polls are national polls, but in the United States, we don't have national elections. We have state by state elections, and then each state sends a certain number of so-called electors to the Electoral College, and that's how we decide the president. So national polls are practically meaningless because that's not how we hold elections. Now, with regard to Biden, his mental deterioration is now obvious to all. Many people have suspected for a long time, but it's now to the point he cannot stand on a debate stage. He cannot go one-on-one with reporters without basically scripted answers and scripted questions. Even then, he's not on solid ground. So he'll likely be replaced as the nominee, literally in perhaps the next couple of weeks, because you've got to get that done before the debates come up. You either have to cancel the debates, which would be a real sign of weakness, or substitute for the nominee. So we might see, perhaps Hillary Clinton. I'm not forecasting that, but she would be in the mix. Um, uh, Maybe a Bernie Sanders, maybe Liz Warren, maybe I think Governor Andrew Cuomo of New York might be getting positioned for this. So don't be shocked if you see a substitute Democratic nominee.
Well, Jim, we heard it here first, and I'll try not to be shocked if it all goes as you've predicted. Now, against this backdrop, you say the United States is looking at the worst economic crisis in its history, a new depression that could be worse than 1929. We're now seeing riots across the US. What needs to happen to stop this prediction from being realized, or is it too late?
I've seen riots before. I was around in the '60s, and we had awful riots in U.S. cities. But the governors and mayors tried to enforce the law. This is the first time I've seen riots where governors and mayors did not enforce the law. So that's the first thing you need to do is enforce the law. As far as the pandemic is concerned, we need a vaccine. There's a lot of confusion. You hear about breakthrough drugs, but many of these are treatments. There's a difference between a vaccine and a treatment. A vaccine will actually prevent the disease, or if you like, cure the disease. Treatment is useful. It'll relieve suffering, reduce the fatality rate, enhance the chances of recovery. Those are very good things, and we should pursue that also. But there have been 6 coronaviruses that transferred from animals to humans. Of the first 5, we've got vaccines on none of them. We are 0 for 5 in terms of coronavirus vaccines. This is the 6th, so there's good reason to be cautious or perhaps doubtful that we'll actually get a vaccine for this.
So, Jim, without enforcing the law or a successful vaccine, times are still looking pretty turbulent. How are you advising individual investors with assets to preserve to protect themselves and their assets?
For individuals with more wealth to preserve, I just stick to the same recommendations I've had for a long time, Lel. The 10% in physical gold bullion, about 30% in cash because it gives you a lot of optionality. It's also a good hedge against deflation. I like residential real estate. Commercial real estate, I think, is an awful investment right now. It's several years away from a bottom. I have that from some of the top commercial real estate investors in the world, multi-billionaire investors. I've heard from them directly that they're telling their people to do nothing.
Now, Jim, that's a pretty dire prediction for commercial real estate to be several years away from the bottom. When do you think will be the right time to buy back in?
Yeah, there'll be a bottom somewhere, and there'll be a time to buy, but perhaps at the end of 2021. So I'd keep away from corporate debt and commercial real estate. I think equities have another leg down, but I like treasury notes, cash, gold, and residential real estate because people by the millions are fleeing U.S. cities.
Fleeing US cities, who would have thought? But in light of coronavirus, it's interesting to hear your consistency with investment diversification guidance. Now, looking ahead at the new decade, what themes do you think will define the 2020s?
I would think the biggest single thing, Lalda, is as was the case in the Great Depression of the 1930s, this is not a recession. This is a depression. And this will not be over quickly in 6 months or 18 months. This will have intergenerational effects. Now, if you define the economy by technical recessions, 2 quarters of declining GDP with rising unemployment, et cetera, the recession may be over already. We may have positive growth in the 3rd quarter, but we've dug such a deep hole, it will take years of growth to get back to where we were.
So, Jim, when do you think we will recover from levels of output seen last year?
We will not recover 2019 levels of output until 2023. we will not recover 2019 low levels of unemployment until 2025. World trade will take a similar period of time to recover. This will be true around the world. So tactical recession may be over, but the depression is just beginning. There are mental health aspects to this, there are psychological aspects to this. And my expectation is that it will take 30 years to get back to normal, which was also true in the Great Depression. You know, the stock market hit a high in October 1929. Ask people, when did it recover that level? When did the stock market get back to the 1929 level? The answer is 1954. It took 25 years. It doesn't mean there was no growth in the meantime. There was, and stocks hit bottom and came back, but it took 25 years to recover that prior level. We may be looking at something similar now.
30 years. Now, that is quite the forecast. I'd like to think we could also arrange an interview then to check up on these predictions. But for now, James Rickards, thank you for your legendary insights.
Thank you, Lavla.
And thank you for watching. Now, if you like what you see, please do share the video, subscribe to TCN TV, or drop us a comment. Tell us who you want to see next and what you want me to ask them. Or if you're an investor, send us an email so we can keep you in the loop with the latest ideas to empower.